Imagine I offered you two coffee shops for sale. Coffee shop A makes $100,000 a year and costs $1 million. Coffee shop B also makes $100,000 a year but costs $2 million. Which one would you buy? Most people would choose coffee shop A because you're paying less for the exact same amount of profit. Well, that's exactly what one of the world's most famous investing metrics helps you determine in the stock market. It's called the price-to-earnings ratio, or simply the PE ratio. By the end of this video, you'll know exactly what it is, how to calculate it, and more importantly, how professional investors actually use it. Let's start with the basics. PE stands for price-to-earnings ratio. Simply put, it tells you how much investors are willing to pay for every dollar a company earns. Think of it like buying a business. Before buying any business, one of the first questions you'd ask is, how much profit does this business make every year? Then you'd compare that profit to the price you're paying. The stock market works exactly the same way. Instead of buying the whole business, you're buying small ownership shares, and the PE ratio helps you compare the company's price with its earnings. Now, let's see how it's calculated. The formula is actually very simple. PE ratio is equal to share price of today divided by the EPS, which is earnings per share. In our example, we got 20 bucks, which showed that investors are willing to pay 20 bucks for each $1 the company earns. But how to find earnings per share? Earnings per share is just net income divided by total outstanding shares of the company, which got us our $5, which is used in part 1. Another way of calculation would be market cap divided by net income, which got us our 20 as well. Now, here's the question most beginners ask. What does a PE ratio of 20 actually mean? It means investors are currently willing to pay $20 for every $1 the company earns annually. Going back to our coffee shop example, imagine the coffee shop earns $100,000 every year. If someone is selling it for $2 million, you're paying 20 times its yearly earnings. That's a PE ratio of 20. The higher the PE, the more investors are paying relative to current earnings. The lower the PE, the less investors are paying relative to those earnings. But that doesn't automatically mean one is better than the other. Many beginners assume a low PE means a stock is cheap and a high PE means it's expensive. But investing isn't that simple. A company with a high PE often has strong growth expectations. Investors believe its earnings will grow significantly in the future, so they're willing to pay more today. On the other hand, a low PE might mean the company is undervalued, or it could mean the business is facing serious problems. Maybe profits are declining, maybe demand for its products is falling, maybe the company has too much debt. That's why the PE ratio should never be looked at in isolation. Always ask yourself, why is the market assigning this PE ratio to the company? Let's look at some real-life example. The companies we are all familiar with, Pepsi and McDonald's. McDonald's has a PE of 22 while Pepsi PE of 18. So let me ask you a question. Which company looks cheaper? At first glance, most people would probably say Pepsi because it has the lower PE ratio. And based purely on earnings, that's correct. Investors are currently paying about $18 for every $1 Pepsi earns, compared to about $22 for every $1 McDonald's earns. But here's where many beginners make a mistake. A lower PE ratio doesn't automatically mean Pepsi is the better investment. It simply means the market is currently paying less for each dollar of Pepsi's earnings. So why might investors be willing to pay a slightly higher PE for McDonald's? It could be because they expect McDonald's to deliver stronger earnings growth, maintain higher profit margins, or continue expanding more efficiently than Pepsi. While on the other hand, if investors believe Pepsi faces slower growth or greater challenges, they may be less willing to pay a premium for its earnings. Which we can see from here that McDonald's just beat its earnings and Pepsi missed the EPS, justifying the reason for the PE ratio. This is why us as smart investors never look at the PE ratio by itself. Instead, we have to ask even more important question. Why is the market valuing these two companies differently? That's where real investing begins, which we will be talking about earnings growth in our next lesson. See you in our next video, folks.